Hello, this is Jenny Clark with Solvability, and today I'd like to talk to you about managing cash flow as a government contractor. Now, these are tips that I'll be talking about specifically for small businesses, and are based on the experience I've had working with companies for really long time. So I hope that I can give you something that'll be useful. So I'm calling this topic Do's and Don'ts for Managing GovCon Cash Flow. The federal contracting industry is different than any other industry, and to be successful at it, you have to be really good at paperwork, at bureaucracy, understanding arcane rules, and being able to respond to things that you have no control over. So the first thing I like to talk about with this is who are the owners of the company, who are the decision makers in your company. If it's just you, you're the owner, you're the 100% owner, you're making those decisions for yourself, you're still going to have to balance your company needs versus your personal and family needs. But if you do have business partners, it's even more imperative that you come up with ways that you can negotiate your company and personal needs among the owners. They could be different ages, they could be spouses, they could be divorced spouses, they could be unrelated parties, but whatever it is, you've got to have a really good process and method to really deal with the different objectives for your company and for people's personal needs. So the little slide I've got up shows Chip and Susan. I've been using them in my marketing for a long time. I felt like it was time to bring them back because they remind me that the needs of the owners are all about figuring out how to work together. So let's talk about the do's and don'ts for cash flow. I want to start out with the things not to do, the things that I think will get you in trouble. Just starting out, so let's talk about that. I've got 10 of these. One thing you need to understand when you start your company, you're kind of strapped for cash. You probably have money in savings. You've got money that you've saved up to start the business, and you need to use that money to bring on people, to rent office space, to pay for attorneys and accountants, and all the cost of setting up your company and moving along. As your company matures, though, you want to get beyond the point where you're having to take draws. Let's talk about what a draw is. If you're 100% owner of the company, there's money in the checking account. You can draw that because it's earnings that you put into the company. It's your money, and you can use that until you decide that you're ready to start establishing a salary. You want to talk to your tax advisor, your accountant, and find out how to treat it. To me, what I had always been advised is take draws when you're starting out. Once you see that you've got some steady revenue, establish a reasonable salary for yourself and pay yourself on a regular basis so you're not tempted to kind of borrow money back and forth between your company and your personal, between taking draws or taking less draws or putting money back in because you have to loan it back to the company. You can also call it, during that process, shareholder loans. There's something called due to shareholder and due from shareholder of the back and forth. It gets kind of confusing, so if you do want information about this, I'd recommend you talk to your accountant about that. But starting out, you'll take draws, but you do want to get to where you're establishing a salary. Why? Because as a federal contractor, they are going to require that you present your financial information, and they're going to expect that the owner of the company has a role in the company and is compensated for that role as the chief executive officer. And in order to recover your salary, you've got to price it into your bids. You've got to prove that you're paying it, and you will pay that salary, and you will pay salary taxes, federal Social Security and Medicare taxes as you go along, just like anybody else on the payroll. So you're really not treated any different. But keep this in mind as you're getting set up, that you do want to establish a reasonable salary for yourself starting out. The second thing I'm recommending that you don't do is don't be liberal with personal loans to employees. Someone will approach you and they've got an issue. They could have a family member in the hospital or a travel issue or something going on in their lives, and they'll say, could I have an advance? And being generous, you'll want to give them an advance. And the next thing you'll know is you've turned into, it's unclear when they're going to pay that back. You expected that they would take it out of their next check, 100% payback, and they're like, no, could you spread that out over 6 weeks or 6 months? and you've started to create something that you really didn't intend to have. So be clear about what your rules are. You don't want to have to stop yourself from closing a deal with a big customer because one of your employees, again, is approaching you for a personal loan and some other I need your help boss type things. They're working for you, and you need to set the standards and recommend against personal loans. Another thing I recommend that you don't do is don't go out and give yourself an immediate bonus when you've heard you won the contract. A couple of reasons for that. First off, there could be a protest. You might not actually get it. You might have won it, but there's no funding. It might be that you've won it, but they're not actually going to let you put people on the contract for several months. So there may not be revenue coming in for a while. You don't want to bonus yourself out until the revenue, the billings have started coming in, you've got the revenue and the profit, and you can plan on it, and then at that point you've actually earned that bonus. The other thing is you'd be tempted to go, we put so much effort into this bid, we've worked on it steady for 2 months, I've been underpaying myself for 3 years now, I deserve more, I'm going to go ahead and give myself a bonus. Well, spread it out over time, figure out a way to do it that's reasonable, pay it once a quarter instead of annual, but make sure that you're not negatively impacting your cash flow, because once you pay it out, you can't get it back. Another thing I've seen people do that I also don't recommend is don't sign yourself up for season tickets for your favorite sports team and run it through the company. Yes, you can do that from an IRS standpoint, but is it a good idea? As a federal contractor, that would fall under a category called unallowable cost. Unallowable cost does not mean that you can't spend it. It doesn't mean that you can't deduct it from your tax returns. What it does mean is in the pricing for your contract bids, you can't include the cost of those season tickets because like interest and entertainment and lobbying, alcohol, and differential of first-class airfare, those are on a list defined by FAR 31205 of unallowable cost. And those are actually coming out of your profit. So when you bid a contract, you bid the direct labor and then allowance for fringe and overhead and G&A, and then a fee percentage or profit percentage, maybe between 6 and 12%. And so those season tickets come out of that 6 to 12%. So if you're on the low side, and things are very competitive right now, we've been under this lowest price technically acceptable LPTA environment for quite some time, you're going to find out that your profit isn't high enough in order to take care of those season tickets. So recommend that you don't do that. Don't run out and celebrate your success with a new sports car or a bigger house or the boat you've always been wanting. Again, you're mixing up the fact that you have a company that is the sole source of your personal finances. Well, maybe you're retired military with a lot of years of service and you've got something else to back up, or you have a spouse that's working or some other sources of income. But be careful about what you're doing with this. When you buy that new sports car and then for some reason you have a blip that whoever is supposed to approve your payment to get your payment on your invoices is out for 2 weeks and you have to come up with a way to cover payroll while you're waiting, the fact that you've got a pretty high car payment to deal with, it's just going to add to your worries and be something else you're going to have to worry about at night. So I wouldn't go do that. Also, another thing I'd recommend against is you're getting ready to renegotiate a line of credit or you're going to have to increase your line of credit. That is not a good time to go out and refinance your house or, worse yet, buy a larger house. All of these things are actually tied in together because your line of credit frequently have a personal guarantee. They will look to your personal credit scores for that. When they see a lot of activity on your personal credit, it could impact your business credit. Even though you want to say it's not fair, that's not the way I want it to happen, until you've established yourself, you're going to be under those type of rules. There are other ways to finance your federal contracting company besides a line of credit. It's going to take a good amount of history in your company to qualify for a line of credit anyway, but be aware that you're really just one entity now, that you've got your own company and you're self-employed, and the salary from your company, the profits from your company are your source of income. Don't recommend floating your company across credit cards, although I have to admit I'm no different than anybody else. I get one of those checks in the mail that says cash this check, and you've got 12 months at no interest to move a high balance interest credit card to this new one. And that is not a bad idea. I see them all the time. But pay attention to what you're doing and which credit cards you're floating like that with, because you've got your company credit cards that should be exclusively used for business and your personal, but a lot of times you're on a trip and you pick out the wrong credit card, or you don't want to change what's the credit card on file. Things start getting mixed up, and before you know it, it's a little bit more out of control than you would like, and you're really not sure how much money the company owes you and how much money you owe the company. Big mess. Another thing I say, let's don't do this, is don't overpay yourself and then start hiring family members. If you are in a family-owned business and it's a hardware store or something different, not a federal contracting group, a lot of people will say, I'm bringing on those family members because they want to work with me. We love working together, and it's a way that I can pass my legacy on down to my children, and that's what I want to do. That's great. But in the federal contracting business, you will have comparison of your compensation to your competitors in certain situations. You should pay yourself a market salary, but you shouldn't pay yourself horrendously above that, or you'll be non-competitive. There's also a lot of reporting requirement that kicks in as you grow, where eventually you'll have to list the top 5 or 6 executive salaries on some public portals. And salary and benefits are not your only type of compensation. There are a lot of other ways to do it. The other reason you don't want to have family and friends on the payroll is when things get sticky, those are the hardest ones to go say, I can't have you working here anymore, because you've got a real tie to those people. You brought them on because you trusted them, and they've been doing a job and you need that done, and it's just a very awkward situation. I have seen people that they want to bring on their spouse, so because their spouse is maybe a non-working spouse and they want to bring them on so they can get Social Security and Medicare benefits paid in. That can be the case too, but make sure in the federal contracting business when you do that, that they show up for work, that they fill out a time card, and they actually deliver services, because it will be scrutinized. Another thing I recommend that you don't do is don't be super generous with paying your consultants and your subcontractors in the sense of paying them earlier than their invoices due. Here's the deal. A lot of times when you start out the company, you want to have employees, but one fast way to grow the company is to have a few people that are 1099 consultants, which means they don't receive a paycheck. They do some work and they invoice, and there's an independent contractor checklist that the IRS does to make sure that they shouldn't be treated as an employee, because obviously IRS wants you to pay for Social Security and Medicare taxes. When you have these consultants, you want to treat them just like everybody else, because they're kind of part of your original family. These are the people that believed in you when you were starting your company. And a lot of times people say, well, I'll just pay you on the same cycle as payroll. Before you know it, you're also figuring out that well, I know we had a holiday and you didn't get to work, but I'm going to pay you for it. Things start to really blur along the edges, and that will definitely get you in trouble. So the recommendation is that if you do have consultants, they should have a consulting agreement. They should invoice you in detail. They should itemize their hours and their billing rates, and they should show the dates on which those hours would work. So similar to a timesheet, but I would not have them fill out a company timesheet, because you don't want them to be treated as employees. They are a third party. Also, either set up what you think are reasonable terms, but the reasonable terms to me would be pay when paid, which means they get paid when you get paid, or something along the terms of net 30, so that you have time to invoice for those costs and receive payment from your customer. On subcontractors, it's the same thing, but it's a much higher order of magnitude. You go through the month, you've paid your employees on the 15th, you paid them on the 31st, and you invoice on the 7th. Well, you had to borrow the money to cover that payroll for that entire month before you could invoice for it, and then you're still going to have to wait till you get paid the full amount of your invoice before you can really cover it and start having some cash flow. With subcontractors, the terms you need to set up are called pay when paid, +5 or 7. And what that means is you'll have a cutoff for your invoicing cycle with your subcontractor, and you will say, you must get your invoice into me by 3 days after the end of our billing cutoff or whatever that is, and they need to get it over to you, so that can be included with your current invoice. So that when you're invoicing for your time for the month of April, you've also got your subcontractor's time for the month of April, and everybody stays on cycle. When you get paid for April's invoice, which is dated in May and probably is going to be paid in June or July, even August, for the first few billing cycles, that's when you pay your subcontractor. If you were so generous as to pay them up front before, like net 10, that means that you could be fronting them almost 90 days worth of money. Boy, that's a great loan for them. But you don't have that kind of access to cash. And by the way, when you do have a line of credit, sometimes there's a borrowing base. I recommend that you exclude subcontractors from that borrowing base, and that you also have a separate accounts payable total for your subcontractors. So you can always look at a total accounts payable aging report of, say, 1.5 million and know, oh my gosh, that's only 200,000 because 1.3 million of that was subcontractor. I don't really owe that until I receive the funds. It's still a liability. I still have to recognize it, but I don't have to pay it yet. The last thing on my don't do this list is don't borrow from the company to pay your income taxes. I don't know why it is that people don't think about their federal income taxes, whether it's the quarterlies or whatever they think they're going to have to pay on April 15th until later in the year. You want to do tax planning much earlier in the year. You probably want to take a good look at it with your government contracting tax accountant and talk to them about what you're going to spend between September and the end of the year, what your revenue, your projected profit's going to be. You want to have a really good track as you go into the end of the year to project what your taxes are going to be, because you really don't want to spend a lot of your cash to increase your expenses to get your net profit down to reduce taxes. That gets rid of all of your cash and puts you in a really tight situation. And when you have multiple owners, everybody's pulling on that same cash drain at the same time, and that makes it much tougher for everybody. So it causes a lot of partner discussions, which are not pleasant. Okay, so now let's talk about what to do to manage your cash flow. And I've really got about, I think, 15 of these. The first thing is, when you're starting out your company, I recommend that you go with an S Corp instead of a C Corp, instead of a LLC, limited liability corporation. Obviously, discuss this with your attorney and your tax accountant and find out what your options are. As a federal contractor, an S Corp allows you to pass through your net income of the company to your personal tax returns, and then obviously you'd also have your salary on your personal tax returns. LLC can be treated as an S Corp, but I should tell you I'm not a tax accountant, not a CPA. The reason that LLC causes extra issues for federal contractors is because there's a member agreement, and they have guaranteed payments, and they have defined how the split of the profits will be handled, and there'll be issues with how distributions need to be made between the partners. Limited liability corporations were set up so that companies could own other companies, and if you as a federal contractor get to the point where that's an issue, then you can change your corporate status to another form. But LLC, because it creates this guaranteed payment, and it's hard to say that salary, it's harder to justify your labor salary for the owners in how the pay works, because they are not necessarily paid on the payroll checks. So there's some issues related to it, and what happens is you'll have people that are trying to help you set up your payroll that don't know the ins and outs of this, and they'll do it wrong, and you won't know until the taxes are about to be filed, and that gets too late to do what you should have done. Costs you a lot of money and confusion that you might have been able to avoid. So that's my 2 cents. When you're setting up, another thing you need to consider is talking to your accountant and your tax attorney and your attorney that's helping you with their corporation, talk to them about getting a buy-sell agreement and key man insurance. And what that does is if something happened to one of the owners, the key man insurance covers the ability of the company to buy the shares of the person that it is no longer with us from their estate or whatever the setup needs to be or whatever their family member needs to be. But a buy-sell agreement and key man insurance are used by a lot of federal contractors and a lot of other companies really to protect the company's ability to continue when something happens to one of the partners. To manage your cash flow, and the other thing I'd like to recommend is that you really spend some time up front determining the needs of owners. Who's going to put in what equity? What way is it going to be structured? What kind of work effort are you expecting? Is one of you going to be the CEO and the other will be the COO? Are you going to have the same vacations? Are you similar in your goals, or is it somebody that's close to retirement age and somebody else that has a young family? You need to talk about those issues because every couple of years they need to be readdressed and say, where are we now? The person that's closer to retirement is going to want to put more money toward retirement. The person that has a young family is really going to be worried about, I need some salary now. I've got bills now. We're moving to a bigger house. I'm getting ready to have twins. So there's a lot going on. Number 4 on my item is to pay back shareholder loans before increasing your salary and benefits. Many times I come into companies that have been operating for about 5 years and we're looking at their balance sheet and income statement, and I start asking questions about oddball amounts that are on their balance sheet. And there's usually something that'll say shareholder loan or due from shareholder or due to shareholder. I'll ask them about it and they'll say, I don't know, the CPA put that on there. There are times when during the preparation of the tax returns, the CPAs will make certain entries and they're the ones that understand how to do it. I don't know because I'm not a CPA, but I do know that at some point those shareholder loans would expect to be settled, and there would be times where you might choose to pay back, the company pay back the loans that you put in instead of taking salary, because salary you're going to get taxed on. Or it could be another situation where you want to be able to forgive the debt that you have between the company and your personal and the shareholder loan. So there's a lot of different ways that needs to be structured, but when you pull up your balance sheet, you should be able to go line by line and know what everything is. And if you don't understand it, start figuring out what it is, because you don't want to move along with the company and have a lot of things on your balance sheet that when you try to go for serious financing, they look at your balance sheet, your income statement, and say, oh, this can't possibly be right. Or when you first have your first review or your first audit, there's a lot of digging that has to be done by the CPA firm to get the details of all of those, because you changed accountants like 8 times during that period of time. And the person that does your personal income tax and the person that does your business income taxes, corporate, should probably be the same person, but that doesn't mean that when you start a business, you go to the person that did your personal income tax and say, do my business as well. You really should be taking a look with a clean set of eyes and stepping up to another level of support at that point. I think I already mentioned briefly, don't use up all your cash to reduce year-end taxes. I don't know how many times I've gone into companies and I said, well, how come you didn't make any money in 2012? And they say, well, we were trying to avoid taxes, so our tax accountant told us to go out and buy some office equipment or do whatever. And sure, you can do all that. But what happens as a federal contractor is that uses up all your cash. Your cash is coming off the line of credit. You've really increased your indebtedness and incurred more interest expense. And you also are going to start bouncing against the limits on your line of credit if you do things like that. The other thing is 2 or 3 years from now, when you're trying to go to a bigger bank loan or you're trying to sell your company or trying doing something else, they're going to ask you for 3 or 4 years worth of financials, and they're going to ask the same question I did. What happened in 2012? Why didn't you make a profit? And it just ends up sounding kind of lame that we decided to go buy a Humvee that year. It's not a good business decision. It's not a problem to pay taxes on profit. There are other ways to manage your taxes by using tax planning and talking also to someone that does your benefits, 401k, your Roth, your insurance, and talk to somebody that's a financial advisor that really understands in depth your personal financial situation and your goals and your company as well. So that's kind of a long way to say don't spend all your cash at year end. I already mentioned use your credit cards only for business. You want to make sure you're also setting a good example in that. Most companies have gone to where maybe one or two of the owners will have a corporate credit card, and it's only to be used for corporate expenses, primarily travel. And if they are going to have travel expense for the company, they'll typically have the airline tickets will be charged for everybody on the one corporate card, but otherwise the employees travel on their own credit cards is pretty much the trend. You don't want to use your company credit cards for personal and your personal credit cards for companies. You just want to keep that clean, because otherwise there's a whole bunch of extra work and reconciliation that's being done by your accountant that's costing you extra money and that's keeping your financial data reporting from getting to you on time, because they are determined to reconcile the bank account and the credit card statements, because that's what their main thing is as part of the original month-end closing. And if you've added to them 2 pages of credit card transactions just because you were too lazy to get your personal card out when you should have made that change, then you're paying people to do a lot of reconciliation that you should have done by swapping out the cards in your wallet. So definitely want to create a line between your personal and business, and you shouldn't be subsidizing or using business funds for personal or vice versa. Some other tips to manage cash flow. Number 8 is obviously make arrangements for a line of credit with the bank. You're not going to qualify for a line of credit until you get to be a certain size and you've got some history. You will usually find your community banks are going to be able to do something with you when you're getting started. People will say you can go get an SBA loan, and yes, you can, but you should first go to your banker and find out what they can do before you go through all the extra paperwork and everything else for the SBA loan. If you're in the services business, it probably doesn't make that much difference. Number 9 is make sure you're financing your capital investments with term loans. And here's what I mean by that. Many years ago, I was working with a company. We kept bumping up our line of credit. And what I went back and realized is they bought a $150,000 specialized gas spectrometer or something like that. And they just paid for it out of their line of credit. And it would have made more sense to finance that over 3 years, because what they really did is they lopped off $150,000 off the top of their line of credit of borrowing capacity. So if you're getting ready to redo the office and you're going to buy all new office furniture and things like that, yeah, you could pay $40,000 off your line of credit just to buy that outright. But my recommendation would be to finance that maybe through the company, or if you're buying computer equipment, Best Buy has 18 months no interest. But try to match the usage term of those assets to the appropriate liability to pay it off. Don't just, grab it off your line of credit, because you'll run out of cash. I definitely recommend you invest in automated systems and also outsourcing of corporate services, and that's more to keep your headcount balanced than anything else. If you have a company with 15 employees that are direct billable employees, and you have 3 people in the corporate function, and you could find a way to outsource your accounting and your payroll and eliminate one of those positions, then you have more planned costs, less supervision, less office space, less benefits to balance, and it ends up saving you money. The other thing is you're not having to go back and train people and supervise them all the time. You're buying a service, and that's how a lot of people are successful as federal contractors. Payroll service, I 100% recommend that you outsource payroll service, let them handle all the tax payments and everything, because that's the first thing that gets companies in trouble when they do have cash flow issues. They know they're going to pay their rent, they know they're going to pay their payroll, and sometimes what happens is the next big chunk of money is their payroll taxes, and once you miss a cycle or 2 on payroll taxes, you've got interest and penalties, and it's very painful and difficult to try to catch that up. Number 12 is when you start a new contract, wait about 90 days before you do any kind of these celebrations, whether it's giving raises or adding indirect new hires or giving yourself pay increases, especially for the executive team. Because even though that contract started, you have a whole bunch of upfront cost to bring those people on payroll, to pay for their benefits for a month before you can even start billing. And then when you're first starting to do the billing, there's frequently issues with getting your billing submitted correctly to the right agency. I don't know how many times I've had people say, well, I just look at the instructions on Wide Area Workflow and upload. I guess it's called IREF now. And that's true, but they'll get up there and they'll start to try to submit it, and then they'll find out, oh, those codes aren't any good anymore. You try going back to the contract specialist and find out, oh, well, that person that set that up isn't here. I think they did it wrong. And the person you need to talk to is in training, and it's almost Thanksgiving, so we'll talk to you the first week of December. So just be thinking about this. When you start up a new contract, wait until you are current on your they're paying your receivables on a current basis, and they're paying them promptly before you go and spend any celebration money. Now, obviously, when you have something like this, you may have to bring on somebody new in HR, somebody new in accounting to cover the workload, but you can also sometimes handle that as a surge position because you really only got a big onboarding event, and once you get past that, you'll be fine. I've already mentioned set up your subs for pay when paid, but it's so important I had to throw it in here a second time. Waiting for your profit to be realized before you start doing bonuses and pay raises. Now think about it. Even though you want a big contract and you're billing more and you're going to have more cash coming in, of that first set of invoices, probably you're not profitable on a cash basis for several months, more than 90 days, because you first have to catch up with the payroll and get things smoothed out. So make sure that you're to the point where you've got steady cash flow and you started earning that profit, earning that fee that you bid originally. Now, the other thing is you may have bid that contract 18 months ago, and at that time you thought the salaries would be this, you thought your fringe, overhead, and G&A would be that, and you bid 7% fee. Is that what your fringe, overhead, and G&A are running right now? Is that what were you able to hire people for what you had to bid? You only had 3% escalation and your costs are rising by 6 and 7%. So that's why you really need to be paying attention to this. It's a tight market and there are strategies to be successful, but managing cash is probably the biggest thing for a high growth federal government contractor. You should have a owner's bonus and compensation plan that you've worked out ahead of time with your government contracting accounting person, a tax accountant, and frequently you'd want to involve an investment advisor, somebody that is well-versed in the 401k plan, can offer you some options for Roth and other ways that you can provide compensation for yourself as the business owner and protect personal assets at the same time. And there's so many different tools, and there are people that I can recommend to you that can really make a difference in how much financial security you come back with by having an appropriate plan. You should know your strategy for what's called step, succession, transition, exit, and planning. And you're thinking, well, I just started, so I don't know. Well, have an idea when you start what your thought is for what you want to do in your company. Everybody, of course, wants to sell their company to Boeing or Lockheed in 5 years and make a bunch of money, but it doesn't happen as often as you think. You've got to have a backlog of prime contracts, meaning that you have got a 5-year contract at the point that you're trying to sell, and it's got funding on it, and it's in an agency that is growing, and you've got a great relationship with the customer, and they are buying your company for your contracts and your contract base. Otherwise, people look at ESOPs, ESOP is employee stock ownership programs. Those usually aren't set up until you've been in business for a while, but many companies in federal contracting, that's the path they choose because they felt like the people that were with them should participate in the benefits, and it is a way for some of the senior people to cash out or have access to that cash. But in any case, you have to keep that in mind because you're always needing to consider what the owner's needs are in terms of where are we going and what's in my cash and how do I preserve our line of credit so we can grow as fast as we want. Because if you spend the money, your cash in the wrong places, you don't have the money to finance the growth when you see a great opportunity to go get some work with another agency and you know you're going to have to spend $30,000 on a proposal and you don't have it because you just bought a fancy car and you're just too tied up and it's all making you crazy and you can't sleep at night. Last thing I would say is to have regular meetings with your executives on your financial status and cash flow. The caveat I would add to that is that probably only the owners will really talk about cash flow and some of the more substantial issues, because if the management team starts to feel like you don't have the faith and you don't have the confidence, they start worrying and it just ripples all the way through your company. And you've got to have other people outside your company that are trusted advisors, part of your team, attorneys, mentors, accountants, and other people that you can have these substantial discussions with so you have some resources, because it does get lonely at the top. So just wanted to wrap up by telling you that Solvability does a lot of this type of training, and I'm definitely wanting to expand it if you have topics you'd like to hear. But what I'm trying to do is teach you things that I had to learn on the job over 30 years. And of course, I specialized on the finance and accounting side. If you're a business owner, you're focusing on all the great things that you're good at, your technical expertise, your business development and sales, your contacts, your network, and everything else. And probably you haven't gone through as much of the financial as you have, and certainly not specific to the federal market. And that's why we're looking to expand this training, because it's hard to get this information and you really need to be in the room with a lot of people so you can hear from them what their experience has been. There's not really any textbook for it. What we're always trying to work with in any of the training Solvability offers is give you a structured methodology to work with, teach you the concepts so you can apply them in your own company, because every company, every owner, every group of executives has a different set of goals. So we're now offering some live workshops coming up in Orlando and maybe offering them in other locations, because being there in person, if you're taking this kind of a math class, is really helpful to be able to ask a lot of questions and hear the issues other people are facing. But we do expect to have an online version coming as well. And that'll be in addition to what we've already got that I call DCAA Compliant QuickBooks Bootcamp, which is for everybody that really wants to get on the right track starting off and understand the terminology and what the processes are and what this needs to look at as you grow. Because at Solvability, our goal is to help you figure out how you can scale your government contracting business faster and more effectively without making some of these mistakes. And so that's really the role that I play. So if you want to connect with me, the best way to find me is out on LinkedIn. You can contact me through my website at solvability.com. That's S-O-L-V in the word ability.com. We've got a lot of programs on there and would definitely love to hear from you. So thanks so much for listening and look forward to talking to you soon.